and while you're not doing nothing, while your mind is not even on it. But there is a downside to all investments is you do have the potential to lose money. So welcome to Debt Free in IT. I'm your host, Mike. This podcast is for anyone who's looking to get into the IT industry, whether it's for a career change or you're just interested. I think you come to the right place. One of the benefits to becoming an IT professional is you're usually able to make a decent income depending on your area. And then with the growth of remote jobs, it makes those chances even greater because being able to work remote, it allows you to be able to stay somewhere where the cost of living is low, but then where you're working at, the cost of living may be higher. You may be working for a major company that's in a major city. So that pay is always going to be a little bit higher than what it would be if you was working somewhere local. Combining that higher income along with avoiding lifestyle creep allows us as professionals to build up a nice little nest egg. As you build up your nest egg, you might start to think about how can I make my money, make more money for me. And one of those ways is going to be by buying assets. So an asset puts money in your pocket regardless if you work or not, and a liability is going to take money from your pocket. Famous rules to live by. In today's video, I got 5 investment vehicles to make your money work for you. And if you stick around till the end, I got 1 extra investment vehicle for those high risk takers. So let's get to it. So the first investment vehicle is investing in individual companies by buying shares of their stock. So this is when you open up a brokerage account and let's say that you're a big fan of Apple and you start buying shares of Apple. So let's say Apple is trading at $100. You buy a share of Apple for $100. And let's say by the end of the year, Apple is trading at $300. So that initial investment of $100 has made you $200 in profit just from you investing that $100. So that's the power of investing, is that your money makes money while you're asleep and while you're not doing nothing, while your mind is not even on it. But there is a downside to all investments is you do have the potential to lose money. So with this one investment of just putting all your money into, let's say, an Apple, then if Apple has a bad day, then you're going to lose money on your investment. But usually when you invest in something, you want to invest in it for the long term. So you want to hold it 5 years or more, 10 years or more. So usually in that 5 or 10 years, most of the time you end up on the green just from buying and holding. Investing in individual stocks is one investment vehicle you should consider as an IT professional. So one of my second investment vehicles is going to be investing into real estate. So investing into real estate, this is when you buy a house. Hopefully you can rent it out and charge more than what your mortgage is. That way you're making a profit here. So most people, you start out buying single family homes and then they may build up to start getting apartment buildings. And then also there is such thing as house hacking, where some people go and find a duplex. Then that way they can stay in one side, rent out the other side. But this is a great way to generate passive income. So real estate has always been one of the hugest wealth builders that I know of. And like I said, most people, if you think about it, if you talk to someone that's well off, a lot of times they're bringing in some sort of rental income. So real estate is a good investment vehicle for IT professionals or just any professional that's trying to generate passive income. And then on the second hand, if you don't want to own a property, so let's say you're the owner and you're getting the calls in the middle of the night when things tear up. You know, you do have property managers out there, but another way to invest in real estate, and this is a totally hands-off approach, is investing in the REITs. REITs is real estate investment trust. So this is a company that you can invest into on the stock market. There's plenty of them out there. And pretty much what happens is those companies own a lot of real estate. So you got different companies that may own hospital buildings. You got different companies that may own strip malls. You got some that may own apartment complexes. And pretty much with these REITs, they have shares on the stock market. And with these companies, they have to pay out 90% of their earnings to their shareholders. So this is where you can go in and pretty much you're still into real estate, because like I said, these companies own the real estate. They're doing all the managing. They're getting all the calls. It's just you're investing in that company. And a lot of times with these companies, they pay what's called a dividend. Some of them pay monthly, where you invest in this stock and every month you get paid a dividend per how many shares you have. So there's plenty out there on the stock market. Like I said, please do your own research. I'm not in any kind of way trying to encourage you to get into anything. I just want to let you know what's out there. Please do your own research. But REITs is another way that you can get into real estate without physically having to own a property and do all the work that has to go into that property. So real estate, whichever way you decide, either properties or REITs, is a good investment vehicle for IT professionals and just any professional that's trying to generate passive income. Sorry to interrupt this video. According to my YouTube analytics, 84% of my viewers are not subscribed. If I provided any value to you in any of my episodes and you're not subscribed, please consider doing so, as it does help out the channel. Also, if you're listening to this podcast in your favorite podcasting app, please leave me a review and share this with a friend. Now back to the episode. So the third investment vehicle is mutual funds. So a mutual fund, they're actively managed by fund managers, and usually that fund manager's job is to try to beat the S&P 500 or the market every year. So the S&P 500 usually does around 8 to 15% per year. That fund manager is trying to beat that S&P 500. What they do, trying to beat that 8 to 15% by buying and selling shares of different stocks and different kind of securities. So these mutual funds, like I said, it's actively managed, which means that you have to pay fees for whoever's managing that fund. And, you got plenty of them out on the market. So like I said, please do your own research if you're looking to go this route. But usually, like I said, these funds, they're going to have a higher fee because of there is a fund manager that's managing these stocks. So if you can find a fund where they're giving you 30% a year, and then with the fees, you're still making over that 15% of what the S&P 500 does, that might be a good look. But like I said, you want to do your own research, but a mutual fund is a great investment vehicle to get into to generate some passive income. The next investment vehicle is index funds. So with index funds, these are passively managed. So it's the hands-off approach. You're not paying a manager to go in and be buying and selling, trying to beat the market every year. Most of the time, these funds is going to mimic the S&P 500, the NASDAQ. So it's already going to mimic a market index. So with these funds, if you're getting one, and let's say it mimics the S&P 500, so it's going to have the same companies in it as the S&P 500 does. So this is where it could have a couple of shares of Apple, a couple of shares of Microsoft, a couple of shares of Tesla. So this here is a great way to get into it if you're one of the people that want to put it in and forget it. Leave it and forget it. Find you a good index fund, put your money in. It's passively managed, which means that you're not going to have the high fees. And every company has their own set of funds. So if you're on Charles Schwab, they have their own set of funds that mimic the S&P. If you're on Fidelity, they have their own set of funds. But usually this is a great way to get in the market, especially if you're one that want to use that hands-off approach. Like I said, it's passively managed, so you don't have those high fees. It's one of the ones that stand out a lot because, like I said, most people like to put it in and forget it. So it mimics the S&P 500, which means that it's going to hold those same companies as that S&P 500 index. So the main difference between these two funds, the mutual fund and the index fund, is mainly going to boil down to how they're managed. And then, like I said, the mutual fund is going to have higher fees. And then the index fund usually has lower fees because it's passively managed. So when doing your research, you want to weigh out the odds. You find a good mutual fund, hey, that's great. If you want to put it in and leave it and forget it. If you find a good index fund, that's great also. There's no right or wrong when it comes to investing. It's all about what you want to do and what you're paying in fees. You always want to weigh out the options, but as long as you're investing in something, usually you should come out pretty good. So the fifth investment vehicle is none other than your retirement accounts. So the first thing with a retirement account is your 401k. So this 401k is where a company allows you to invest in the stock market through them into your 401k. The 401k is usually you can't use it unless you're about to retire, or you can take loans against it and then pay yourself back. Also, you will have, I think it may have a little small penalty, but you are able to take a loan against it if you're not at the retirement age and you need that money for some reason. But this 401k, like I said, most jobs offer it if you're at a full-time job. Some of them, most of them, or a couple of them is going to at least offer to match whatever you contribute. So if they say, oh, we match up to 10%. Usually a good rule of thumb is if your company match or whatever that company matches, that's the amount that you want to contribute also. So if they match a 10% and you put in 10%, that means that you got 20% going into the market. And usually they may have a set of funds that you can choose to invest in. You know, you have to look at them closely because usually they have a lot of them by different names. And you could seek out to see which one of these is following a specific index. So you could say, okay, I want to invest in one that's following the S&P 500 index. And then you just have your money going into it. But the main thing is whatever that company contributes, that's what you want to contribute also. Whatever they match you on, that's what you want to contribute. So like I said, this is something that I wasn't on early in my career. You know, I remember when I was first entered the workforce, I was working at a hosiery mill making car carpet. And I remember when we got laid off, I remember talking to some of my coworkers and they were like, yeah, I got to transfer my 401k to this other company that I'm going to. And I was like, what's that? And they would tell me, oh, I got this amount in here from contributing to my 401k. I'm like, damn, ain't nobody ever told me that. So that was the light bulb went off then. So then when I started working at the hospital, you know, I was part-time in the first beginning. Then when I became full-time and things like that, I started to have the option to invest. And that's when I started investing in my 401k and things like that. So like I said, it's a way that whenever you retire, you have a good nest egg. And a lot of times it's what a lot of people have to retire from. So you have other things that you get when you retire, but usually they're pulling from their 401k also. One thing about this 401k is it's the money you contribute to it is pre-taxed. So that means that whenever you start withdrawing money from your 401k, you do have to pay taxes on it. So if you have $1 million when you retire and you start withdrawing, you're going to have to pay taxes on whatever you withdraw. So that's one of the downsides with the 401k, but it is a great investment vehicle to get you to where you need to go. That way you're financially set whenever you get to that retirement age. But let's say that you don't want to pay those taxes. That's when we got the next one, the Roth IRA. So that Roth IRA, I particularly like this one. You can have both. So you can open up the Roth IRA yourself in your account. So you can go to whatever brokerage you have, open up a Roth IRA. And with this Roth IRA, you're putting money in after tax. So the money has already been taxed. So let's say you put in $100 every month, you got $1,200 a year. Let's say that when you go to retire, this $1,200 is now grown to $1 million, let's say. So if that $1,200 that you initially put in, you didn't put nothing else in, 30 years later, you got $1 million. So when you start withdrawing out, you don't have to pay taxes on what you're withdrawing because that money has already been taxed. So that's one of the benefits to the Roth IRA. And then also with the Roth IRA, you do have a limit. I think the limit now is like $6,000 or $7,000 that you can put in a year. So you're able to put that in every year, and then whatever it grows to, you don't pay taxes on it. So your 401k and your Roth IRA are the big investment vehicles for your retirement accounts. Now, you do have plenty of other investment vehicles for your retirement accounts, but usually these are the two that I know a lot on. So this is what I use for some of my investment vehicles that I'm contributing to now. But like I said, with anything, don't just take my word for it. Do your own research. Go seek that knowledge on it. A lot of times, like for me, I listen to a lot of audio books about finances, about money and things like that. So tech, finances, and health usually is what I consume the most of. And like I said, this is just some investment vehicles to think about, especially when you get into IT and start generating that decent income where you can start trying to make your money work for you. So if you stuck around for this long, as promised, I have one more investment vehicle. So this investment vehicle is for those who can tolerate that high risk, high reward. And that's none other than investing in cryptocurrency. So like I said, usually this is not a stable investment, but it does involve high risk, high return. So one of the big three in crypto that I can think of is Bitcoin, Ethereum, and Litecoin, with the main ones probably being Bitcoin and Ethereum. So with Bitcoin, you know, if you would invested in it 10 years ago, you'd probably be rich by now. If you invested in it before that, you'd probably be rich by now. So the thing is with Bitcoin and things like that, you want to treat it as not as your main investment, but if you have some spare cash, it is probably good to put some towards Bitcoin and cryptocurrency, especially now as you start seeing where the U.S. government and things like that have started to acknowledge Bitcoin and crypto by creating funds around it too. So that lets you know that, okay, things is probably going to go on the up and up from now. So like I said, cryptocurrency, high risk, high reward, like it's very volatile. If you look at Bitcoin on a daily basis, it fluctuates thousands of dollars. So it's something that you don't want to put everything into it, but it is something that I would consider putting money into. So for me, I do hold some Bitcoin and some Ethereum. You have thousands of other types of coins out there. You know, I'm not well versed on them. I usually just look at the big ones in that category, which is, like I said, Bitcoin and Ethereum. I know Ethereum can be used a lot for a lot of smart contracts and things like that. So it has a use case for it. So those are my two for cryptocurrency, but please note that these are high risk and high reward. So don't put everything into it. You know, you want to put a little at a time or whatever you can tolerate. But cryptocurrency, like I said, it is another investment vehicle that you can use to set yourself up financially. So that brings me to the end of this episode. Hopefully you found some value in this episode. I'm not trying to offer you financial advice or anything. I'm just trying to open up the doors to some things that are available to you. But as always, please do your own research first. So if you're watching on YouTube, Instagram, TikTok, Facebook, you can follow me at Debt Free in IT. If you have any questions or comments, you can email me at debtfreeinit@gmail.com, or you can go to the website debtfreeinitwithmike.com. Other than that, I'll see you next week. Peace.